Welcome to Prime Investor. One of the questions that we are often confronted with while we, answer your queries is the number of funds that you should have in your portfolio. Many of you ask whether, whether 5 funds are okay or I have 12 funds, is that too many, and so on. We're not going to give you a magic formula as to exactly the number of funds that you need to have, but we can definitely guide you on how many funds. So I'm going to take you through a very short presentation that will give you a kind of a guideline on how you can go about fixing the number of funds in your portfolio. Let me take you through a very short presentation on this, and I'm going to share my screen for this. Right. So when it comes to the number of funds that you hold in your portfolio, it is not about really the number, but it's about the mixing of styles and strategies in funds. What do I mean by styles and strategies? Whether a fund is going to, be a large cap or a mid cap or a small cap is one way of classifying it. The other way of classifying it is whether a fund is going to be growth focused or value focused or a mix of these, or any other kind of containing downsides, etc. But it's not easy for you to understand these strategies. But let me just take you through how you can go about doing this. So first, let's talk about what beginners need. When you're just starting out with a mutual fund portfolio, it's a very simple thing. You don't need to worry about styles and strategies because it's hard to grasp. What you can do is just begin with 2 to 4 funds, especially when your surplus is small. You have a 10,000 rupees SIP running, or you have a 15,000 lump sum. You don't need too many funds, and it's hard to also, kind of choose funds. So just go with, 2 of a maximum of 4 funds, even if you don't know what they really do. Let me just give you an example here. Just see how this portfolio looks here. This is our 1 to 3 year portfolio. We have ready to go portfolios for different time frames. This is a 1 to 3 year portfolio. You will see that I have given very little equity here. Asset allocation is a very different topic, and we'll talk about that another day. And I've tried to give that through a hybrid fund, right? So that way you get a little bit of equity and you get a little bit of hedging because you don't know much about mutual funds. So I've, given it there. And then we have added 3, debt funds. In the debt funds, we have kept 2 to very short duration. And the third one is short, somewhat longer. It's called HDFC short term, as you see. So we are, kind of trying to diversify in debt, because in debt, diversification is very important. When one fund falls, you don't want to get stuck with it, as we know that it happened in the Franklin saga, and before that, when DHFL fell out, right? So this is the mix that we have tried to give. So we have given 4. We have given you a hybrid where you'll get equity. And then because this is a short time frame of 1 to 3, we have just diversified. We have focused on diversifying debt than diversifying equity, right? So this is just an approach for a short-term portfolio. The more important thing is stick to 2 to 4 funds. Then as you advance, you start investing 2 years, 3 years down the line, that you need a variety because your fund needs to be performing at all times. Your portfolio needs to be performing even when few funds are not performing. That's where mixing styles comes in. Mixing growth style, value style, and there's something called GARP, and then looking at funds that use a hedging strategy with derivatives and so on. So that's one thing. These are active funds that I'm talking about. The second thing, make sure you add some passive funds, index funds to your portfolio, be it the Nifty 50 or the Nifty 500. The reason I'm saying is that when we are not sure which funds are going to outperform in the active strategy, because fund managers go through ups and downs, you can at least ensure your portfolio sticks to the market by having some passive funds. The third thing for diversification purpose is that you can have some international promotion. If this is a long-term portfolio of 5 years or more, don't worry about what international funds, just go with passive international funds, US focused passive international. We have explained very in detail in this article link that I've given on why this makes sense. This keeps your portfolio simple and it makes a lot of sense. And gold is definitely a diversifier. If you're having a 5-year plus portfolio, gold can be volatile in the short term, so don't try to add them. The way I showed in the 1 to 3 year portfolio, there's no gold, right? So don't try to add gold to such portfolios. You can definitely count on 1 gold. So 1 gold, 1 international fund, then you have debt funds, and then you can mix styles between, your equity funds. When I say, mixing style, it does not necessarily mean that you need 1 fund from each style. It is not so. Sometimes you may not need some styles. I'll just give you an example here. This is our income and growth portfolio. This is one of our goal oriented portfolios where we have given some deposits from RBI floating rate bonds for the income portion, and the rest of the mutual fund portfolio, as you will see, safely stuck to index fund, because we don't know for such income and growth portfolios whether an investor is going to actively manage it. He or she is expecting some income out of it, and we want a more stable growth portfolio. So there is a large cap fund, there is an index fund, and there is a debt floating rate fund. Here I am not, if you notice, we have not tried to add any value here, right? Value focused funds. Why? Because value focused funds can underperform in the near term, and when I'm looking at a portfolio where it's expected to give some income from some portion and some stable growth, I don't want to give strategies that may underperform for a prolonged period. So there may be times when you don't need value. There may be times when you have to stick to passive and not active. This will entirely depend on the nature of your need, of your goal, and also the time frame. The longer the time frame, the more leeway you have to experiment. You can do a little bit of value. If you take our high growth portfolio, you will see it aggressively towards growth. But if you take our 7-year plus portfolio in our ready to go portfolios, you will find a mix of the contrarian as well as growth, the value as well as growth. So this is the kind of mix that you can do with your portfolios. The only reason why your portfolio grow in terms of number of funds and become unwieldy is, one, when you try to start adding every NFO that comes out there. You don't need to add them, because many of the NFOs will already be styles or strategies that are already there in your portfolio, in which case you don't really need to add them. You don't need to add them because they are ₹10 or they have been told that this is a good time to buy it. You can always see if they really will complement your portfolio well. The second reason is when a fund comes in the top of the chart, you are really enamored, or your relationship manager tells you that you need to add it to your portfolio, and you end up adding it, not realizing that you might actually have similar fund in your portfolio and you're duplicating it. And this topper may not last for long, and they may end up pulling down the performance of your portfolio. That's what I've tried to tell in the third point. Adding too many funds, there is a high probability, as your number of funds goes, the number of funds that can perform may be very few. So the laggards might become heavier and pull down the performance of your portfolio. So, maximum of 8. If you really have a large sum, up to 12 funds, for a long-term portfolio, for a large sum, that's up to, typically the recommended. Again, there's no right or wrong, but it's typically how it works for. We have built portfolios earlier for a lot of investors with that kind of a mix, and it has worked well, right? So I'm going to summarize this. For small investments and for beginners, 2 to 4 funds is a good starting point. You should not be taking very high risks in either equity or debt, or mix one high risk fund, debt fund, and one high risk equity fund. As portfolio grows, 6 to 12 is fine. When you wish to add more, every time ask yourself the question whether this new fund will complement your present portfolio. And for short-term debt, please make sure you diversify across AMCs, even if it means duplication. If you're holding 2 short-term debt funds, it's okay from different AMCs, because you don't know when there are liquidity issues with some AMCs. With long-term debt, you don't really need. When you're holding high-quality funds like corporate debt funds or gilt funds, you don't need that many variety. It doesn't matter. These are all highly liquid funds any which way, because they are traded and you don't need to duplicate them with too many. So this way, you can reduce the number of funds that you have, but still ensure that you diversify enough. Now, I told you at the beginning, you need to know the growth, the value, mixing styles. Where do you get them? Do fund mandates, fund scheme information documents tell you openly, or the popular websites that you go? No, they don't. So at Prime Investor, we have this in Prime Funds. We have this column called Why This Fund, where we clearly explain the fund's type: growth oriented, value oriented, contrarian, and so on. This will make it very easy for you to pick a fund and add it to your portfolio. If you can't do that, no problem. We still have something called ready to use portfolios, where we already do this mixing. I showed you a couple of portfolios here. We do this mixing and we build those portfolios for different time frames, for different goals, and so on. You could try that also. And if you want to now reduce the number of funds, because you may be having some underperforming funds, you can actually use our mutual fund review tool. It will help you weed out the laggards and reduce the number of funds in your portfolio to a more, efficient and recommended number. I hope you found this useful. Please, subscribe to our video and like this video. If you have any comments, please put them here. Thank you.